If you've made it this far, you're already thinking like a strategist, not just a trader. So in part 3, let us explore how professional algorithmic trading systems and AI-powered bots actually use EMA and SMA in the real world, not just for signals, but for decision-making. Let's start with the basics. In algorithmic trading, indicators are not about intuition. They're logic gates, meaning every signal has to meet certain predefined conditions. That's where combining EMA and SMA becomes powerful. Standard logic tree might look like this. If price greater than 200 SMA gives trend bias equals bullish and 9, EMA crosses above 21, EMA gives momentum trigger equals buy, and RSI greater than 55 gives confirmed strength, then execute trade at market. Stop below 21 EMA, target at 2R. This decision tree is simple but effective. You've got trend, momentum, and confirmation layered. Why does this matter? Because in real markets, a single EMA crossover means nothing without context. Now here, yes, something most manual traders miss. EMAs are extremely powerful as dynamic trailing stops inside bots. For example, a bot might use a 9 EMA to trail a position in real time. When price closes below it twice in a row, that triggers an auto exit. This is much smarter than fixed pip stops, especially in volatile pairs like GBP, JPY, where candle wicks can invalidate tight static stops. SMA, meanwhile, is commonly used in regime filters. What does that mean? SMA doesn't trigger entries. It defines if the bot should even be active. If the 100 or 200 SMA is flat or sloping down, the bot switches to defense mode or shuts down trades entirely. Why? Because SMA slope reflects market structure. A flat 200 SMA equals no edge. Institutions know this, and so should you. Now here's a deeper layer. Some bots use EMA divergence as a volatility gauge. For example, the greater the distance between 21 EMA and 50 SMA, the higher the expected volatility. If that divergence exceeds a programmed threshold, the bot may widen take-profit targets or delay entries until volatility contracts. Smart, right? This is edge. You can't manually execute at speed, but a bot can. Another advanced tactic, EMO-based scale-ins. A position might open when the 9 EMA crosses the 21. If the price continues to trend and breaks above the 50 EMA, the bot adds to the position. This pyramiding logic builds winning positions only when market structure supports it, reducing risk while scaling exposure. If you're using MetaTrader or Crater or TradingView, this logic can be coded in under 50 lines. But the key isn't just writing code. It's knowing what logic makes money over time. That's where proper backtesting, optimization, and walk-forward testing come in. Let's look at actual performance data from automated systems. In a 12-month study across GBP, USD, and your USD, strategy combining 200 SMA, 21 EMA, 9 EMA had a higher profit factor and lower drawdown than EM-only or SM-only strategies. Why? Because the system respected macro structure, entered on micro signals, and exited on price weakening, not just time or emotion. This three-tiered logic works because it mirrors how professionals trade: top-down, data-backed, and unemotional. But here's the truth. Designing an algorithmic system isn't just about the logic. It's about matching that logic to market behavior, trader psychology, and risk tolerance. If you're interested in developing systems that actually perform, not just fancy dashboards, you need more than code. You need strategy, structure, and smart support. That's why Innohedge is your launchpad. Whether you're a manual trader curious about automation, or a dev looking for real trading logic to build bots around, Innohedge gives you both the tactical and technical foundation. Access blueprints, algorithm templates, and trading logic we've tested in live conditions, not just on paper. Join Innohedge today and go from indicator theory to strategic execution. Let's turn your trading into a system. It's one that works, even while you sleep.